Roku reported earnings last week and the stock soared by over 30%. Shares are now up 124% year to date. At the latest share price, the company has a market cap of $12.9 billion. It's got $1.8 billion of cash and no debt, so the enterprise value is $11.1 billion. The latest earnings report revealed a 16% increase in active accounts to 74 million and an 11% increase in total revenue. That takes revenue up to 3.2 billion over the last 12 months, roughly 7% more than this time last year. However, Roku's bottom line is still in the red. Net income over the last 12 months is negative 661 million and free cash flow is negative 166 million. Stock-based compensation at 389 million is roughly 12% of revenue. Roku's business model can be organized into two parts. The platform segment generates revenue from the sale of digital advertising and content distribution. This segment generated 87% of revenue with a gross margin of 54%. The device segment includes the sale of streaming players and Roku-branded TVs, as well as some other smart products. This segment contributes the remaining 13% of revenue with negative gross margins of minus 17%. So this segment is what's known as a loss leader. By selling its devices at a loss, Roku can grow its user base and then monetize those users with advertising. A crucial component to all of this is the Roku operating system. Roku licenses its operating system to the manufacturers of TVs. This saves manufacturers money and allows Roku to be the go-to platform for viewers. And according to Roku, over 40% of smart TVs in America now use its operating system. As advertising dollars continue to move to streaming away from traditional TV, there's going to be a lot of money up for grabs. Roku has also forged partnerships with retailers like Walmart thanks to its shoppable ads technology, and there's a blue sky scenario where Roku becomes the go-to gateway for all streaming services. The one major problem with all of this is that Roku operates in a hugely competitive market. You've heard of the streaming wars, but the OS wars are also heating up. Google, Amazon, Samsung, Comcast, Vizio, there are lots of big companies trying to gain share in the OS market, many of whom have much larger resources than Roku. Even if Roku maintains market share, its profits could come under pressure. Meanwhile, streaming companies like Netflix are going to do everything they can to get viewers to go direct to their apps, not a third party like Roku. Revenue increased 11% this quarter, but sales and marketing expense increased more than that by 23%, and that contributed to a gross margin under 45%, its lowest since 2019. Roku will likely grow revenue by 5% this year, which isn't enough to justify the valuation. Let's assume Roku manages to get back to 15% revenue growth going forward. That would put revenue at 13 billion in 10 years' time, and if the company can manage a 15% net margin, that would put net income at 2 billion, and a 20 times multiple would put the valuation at 39 billion in 10 years' time. That works out to an investment return of 11.7% a year. That seems reasonable. The problem is Roku seems a long way from positive earnings, and there's a lot that could go wrong. It's hard to predict what the future of this media and the advertising within it will be, and it's hard to see how Roku can continue to outperform much larger rivals. For those reasons, I give the stock a neutral rating, but these are my personal opinions, not financial advice, and I hold no position in the stock. For more detailed investing ideas, make sure to visit our website, overlookedalpha.com.